Welcome to The Real Money Show, the number 18778 Silver, and the website guildhallwealth.com. My name is Jeremy Wiseman. I'm joined by Jerry Correia, and we are closing out the month of April here, and what a wild ride April was. So far, right now, for gold, USD, it's up 6.47% over the last 6 months and up 7% over the last year. In Canadian dollars, gold is currently up 9.64% over the last 6 months and up 11.5% over the last year. Silver, a bit cheaper than it was a couple weeks ago. Silver is down 2.5% over the last 6 months in US dollars and actually down 10.5% over the last year. And in Canadian dollars, it's only down less than 20 basis points over the last 6 months, and it's down 6.5% over the last year. Now, silver is cheaper by price, but not necessarily cheaper to actually buy the product, right, Jerry?
Yeah, that's correct. So the premiums on the physical, so we're seeing a lot of movements, and we're tracking movements from exchanges, COMEX exchanges, LBMA exchanges, LME exchanges, moving product to depositories. And the cost, the turnover, the cost to actually acquire, the spot price, this is a huge bargain at these levels because the price to actually acquire it, to take it out of the market, I mean, the premiums have just continued to rise, up another quarter on silver for us. So our costs here have gone up. But again, no one is coming back to the market. As I mentioned before, no one's selling their goods, Jeremy. So despite what we're seeing, downward spiraling on silver and gold for the last 2 weeks, this is algorithm selling. This is computer digital selling because no one net selling. We're seeing a little bit on the central bank side because they have to cut and try to raise some capital because we saw some central bank losses over the past 2 weeks as well. But what we have to keep in mind with regards to the gold and silver prices, that when we're dealing with these algorithm trades, it responds to the US dollar index. And the US dollar index, which is the US dollar versus a basket of other major currencies, is at a 5-year peak. So, of course, gold and silver on the algorithm side of exchanges have to sell off.
So, look, we're at the end of April here. It's not looking very good in the stock market. The Dow is down. TSX is down. It's still hanging in there over the course of the last 6 months and year, et cetera. But definitely stock markets are down. GDP was down, negative in the States. Their inflation is a real problem at this point. The Fed is raising interest rates. I'm getting flashbacks to 2018 with the taper tantrum. The Fed's balance sheet's at $9 trillion plus. The amount of derivatives on 6-7 banks in the U.S. combined is at over $234 trillion in derivatives. That was not an issue in the 70s. Now, I think that belies the point that what we're seeing in the gold and silver market. Gold did hit up to 1970 in and around. It was just cusping, getting close to the 2,000 mark in US dollars. This time, a month and a half ago, we were trying really hard to get above $1,800. Mm-hmm. And here we are just shy of $1,900. So I look at that in perspective as pretty good. Silver, on the other hand, I think there's a deeper story to why the paper price of silver is down. Do you want to let our listeners know what we're seeing?
Well, interesting times definitely with the exchanges with regards to deliveries and sanctions and having whipsawing effects, especially with the exchanges. So just as we finished our recording last week, we had headlines of the London Metals Exchange are closing down. So they're stopping their trading in silver and gold futures, which is massive, trading a lot of derivatives in the physical in the silver and gold space. For those who don't know, the LME was also involved in an investigation with the way that they handled the nickel debacle. The Britain's Financial Conduct Authority and the Bank of England have announced investigations on how they manage the nickel trade. So for many people who don't know what happened in the nickel market, on March 8th, the prices doubled to a record of above $100,000 a ton in a matter of a few hours on some anticipations that China had to buy metal to cover its short positions. So this is a very huge glimpse into the future, Jeremy. If this happened with the LME having exposure to paper shorts in the nickel market having to shut down, all eyes are on the comics. All eyes are on the rest of the exchange spaces from the SHFE to COMEX to LBMA to COMEX Micro, even to TOCOM. All of these entities are tasked as well, especially in England, to create a default fund. So right after the LME was invested.
Wait. A default fund?
Exactly.
What is that? Who's getting a default fund, and why are they worried about defaulting?
Exactly, because of the ratio between paper to physical. For every ounce of silver that was mined or that was available, there was 300 paper derivatives based on that 1 ounce. And we're going to get into that a little later. But the default fund is every clearinghouse, every one of these exchanges must have a default fund to cover losses, which margins are posted by members, which they can't really fill. And ever since that nickel debacle, the LME has forced its members to contribute even more to this fund, to this pool of rescue bailout money, which they couldn't do.
I feel like this idea of being asked to put up more is going to be a theme for the rest of 2022. This theme of we're going to need a little bit more from you. So they're asking their members to cough up more money. In the meantime, they're saying, look, this market, we can't afford to be in the gold and silver market and have something like nickel happen in this particular market. And I think that goes to show very importantly that the gold and silver market are strategic markets, and they can't afford that kind of upset and volatility in these markets. Now, I've been in this market a long time. I've been doing this for over 15 years. And when I see pullbacks like what we've seen over the last week and a half in precious metals, or I guess since the last week, since this news came out, it is screaming to me that there are entities trying to get out of their short positions on silver. Mm-hmm. That's what it screams to me. Now, we saw something very similar happen in March of 2020 when the price of silver was trading at 17 and went down to about $12.30, $12.50 an ounce. Mm-hmm. Now, when it hit $12.50 an ounce, $13 an ounce US, you couldn't buy it at that price.
No.
For nothing on this world, you could get silver at that price. You were still going to pay a massive premium and get it still at the $17, $18 level. So it was definitely an aberration in terms of paper versus physical. And I think that may be something we see in the weeks and months ahead, that the paper price doesn't matter as much, because what really matters is, can you get it in your hand? Mm-hmm. Can you get that physical product in your hand? So when I see the price of silver pull back to $23, I say, okay, fine. We could chalk it up to continued, the market filling in the gaps and consolidating after its big price run in 2020. But I think this is more about trying to get out of the futures markets, trying to get out of those short positions, because given everything that we're seeing today, and we're going to talk about more on this show, you do not want to be caught on the wrong side of this market playing the futures. So I think they're trying to get out. I think they do it by pushing the market down. Don't tell me there's no collusion in this market, because every major bank has been busted for spoofing and colluding in the precious metals market. It only matters if you can get it in your hand, because look, gold is up 400% over the last 20 years. Silver's not far behind it. These markets are hedges against inflation. They are real money in a time where currencies are becoming worth less all the time.
100%, Jeremy. I couldn't agree more that we do shout this on a regular basis. We have this type of conversation with all of our clients, and many of our clients wanted to know this week what's happening, what's the relationship. Well, it's buy the rumor, sell the news. Next week, Wednesday, Jeremy, is probably the biggest data piece coming out. May 4th is FOMC. The U.S. Federal Reserve is slated to raise interest rates 50 basis points, and that's why we're seeing the U.S. dollar peaking. It's buy the rumor, sell the news. We've hit five-year peak on the U.S. dollar index. I called it before. 1880 was my support level. We hit 1885 or whatnot on support. Gold is now steady above 19. Wait for Wednesday.
Are you petting your crystal ball right now?
Exactly. Just watch for Wednesday. This is the time to be stocking up on your precious metals. These are opportunities, huge bargains of the century, and that is what the next headline we're going to talk about from Jörg Keiner, his speech to Bloomberg Asia. He was interviewed, and he basically called gold the bargain of a century at current spot levels.
The number 18778 silver, the website guildhallwealth.com. We'll talk about that in the next segment and also start to bring in the other markets, not just talk about what's been happening in the silver and gold market. So the number 18778 silver, the website guildhallwealth.com. Stick with us. So much more here on The Real Money Show on AM 640. Welcome back to The Real Money Show, the number 18778 silver and the website guildhallwealth.com. In the last segment, we were just talking about the fact that gold and silver are doing quite well over the last 6 months. You know, gold in Canadian dollars over the last year is up 11.5%. In silver, silver in Canadian dollars over the last year is struggling a little bit in US dollars at negative 10.5%, but we are up 6.5% in Canadian dollars over the last year in silver. This, while the paper price of silver's down over the last week. Why? In our estimation, it's because the LME is about to close its doors on futures trading, and it's, they're giving, what's the timeline on that? I think it's like June or July or something. So they're giving their clients enough leeway to say, get out of the market now. So if you've got short positions in that market, you want to get out. They're probably trying to push the price down to get out of those positions. Also, we are heading into the end of month, and it's probably a nice idea for the major shorts like Bank of America or whatnot, to try to get the lowest price before it rolls over into the next month. So this is probably not going to last very long. At the same time, you can't really buy the physical product. If you can get your hands on the physical product, you'd be very, very lucky. The market is still extremely, extremely tight. So the paper price belies what's going on in the physical world. If you can't hold it, you don't own it. If you can't find it anywhere, then what good does the price do you?
Right.
You have to be able to find it before you can do that. So that's what's going on in the market. Meanwhile, NASDAQ has had its probably worst month since November 2008.
Yeah.
GDP in the States came back as negative. And the Federal Reserve wants to continue to raise rates. Beautiful. They're so behind. They couldn't be further behind the 8 ball. And they're going to try to do what they're doing, but I think it is a massive failure. I think we're going to find that they can't reach their targets. They're way too far behind those targets. There's already negative growth in the States and major inflation everywhere,
which is even more negative growth.
You're going to start to see these headlines where they're talking to the Fed and they're saying, we didn't meet our target this month. We're just going to keep maintaining and monitoring the market, which is basically to say they're not going to be able to catch this inflation thing. Just like they said when they said inflation was transitory and they tried to put that one past people. At some point, the faith in the Federal Reserve completely goes out the window.
Yeah.
And it's going to be every man for themselves. And at that point, what is the value of the currency going to be? Because we're already experiencing stagflation.
Yeah, exactly, and it's causing a lot of malinvestment as well. There's a really a headline that just triggered me just prior to the start of the show. That
trigger like emotionally?
Yes.
Okay.
I mean, this is people's pensions. So
do you need a safe room?
Yes, safe space.
Safe space.
Keep back 6 feet. Anyways, how do you lose $3 billion in a booming market? A massive Ontario pension comes clean on what happened. So this is OMERS, who is it's a pension plan, and a lot of their workers are in the space of Toronto Public Library, education assistants. They had a meeting. What's happening with this pension plan? They lost $3 billion. A lot of malinvestment. A lot of changes. People want to see change because during their last meeting, just the end of the month, last month, during their conference, the union leaders said their members are concerned about losing benefits such as the pension payments that are indexed to inflation or being required to contribute more to make up for investing. Again, the same theme. We need more from you and less from us. So we're seeing people getting concerned, as they should be, with their pension plans. And this is why people have moved their pensions over to Guildhall, into a lira, for example, and they're throwing gold in there. Gold for the golden years, which was what the C.D. Howe Institute, which is a major Canadian think tank, wrote about the Canadian pension system years ago that, this is a massive Ponzi scheme, Jeremy. This is a reality that we have to deal with, a major think tank. And this is not coming from Guildhall. The pension plans are now having to confront their members who are obviously worried, and they have to make some changes.
Well, gold and silver are money. They're not investments. Now, silver, 3 dimes of silver would buy you a gallon of gas in 1965, and the silver content in that would buy you a gallon of gas today. Now, nobody wants an investment like that, but everybody wants money like that. A bottle of Coke cost the same amount of money in 1880 as it did in 1940. That is the type of money that you want in your pocket.
Yes.
Now, if you have that type of money, you're not overly consumed with your investments, and are you getting your 7% a year on investments, etc. That overemphasis on investments is probably a symptom of the fact that you're losing your purchasing power year over year. You just don't know it. Right. You see, gold is the same thing in every country. It's an ounce of gold. But we live in this world where everything is relative. You ask a central banker, how long is an inch? And they say, what am I measuring? Mm-hmm. No, it doesn't work that way. You need a balance. You need to be able to say, okay, we're exchanging the same money, so we can make the proper economic decisions. How many times have we had people in our office where he said, what's the value of the dollar? They say, oh, well, it's 1.28 against the U.S. Oh, okay, great. What's that worth? Mm-hmm. I don't know. Isn't it backed by gold? No, that ended in 1971. Mm-hmm. So we need that even quality to money to be able to make the proper economic decisions. We're so in the dark about what currencies are versus money and what the values are. Speaking of that, Russia is looking to permanently back its ruble with gold, mm-hmm. I heard.
Yeah.
Did you hear that one?
Yeah. That's what I think they were interviewed. The Russian finance minister was interviewed this week, and they're being even more clear about their ambitions and their goals to bring stability, and that's what they need is stability in this time of economic turmoil, geopolitical concerns and risks and sanctions. There's no better way to instill trust with its trading partners, and it's very refreshing that we're dealing with national currencies as opposed to a global one world currency.
Yeah, I think that's kind of interesting that you're saying that about this idea that how much are you going to trust the government to take care of this for you, right? How much do they tax you on income tax? What do you pay after that for everything that you purchase? You pay another 13% after tax on everything else. Mm-hmm. And then inflation, they said, was at 2% when it was really at 6%, so you were negative 4%. Now they're saying it's 7% when it's actually negative 15%. Mm-hmm. The rapid rate in which you're losing your purchasing power and you're still trusting the government with your money. Mm-hmm. I mean, I was listening to something this morning actually about the welfare state.
Okay.
It's not new in terms of what we're seeing, but the idea of the welfare state, Jerry, is that the government gives you free programs, but they're stealing so much more than what they're giving to you. Mm-hmm. It's very similar to when JP Morgan has to, pay a fine, right, for things that they've done in the market. They make $500 million, and then they pay a fine for $15 million or 50.
Mm-hmm. Good trade-off.
It's a great trade-off,
right?
That's what the welfare state is all about. Mm-hmm. So you have to, and the problem is everything's relative. The money's relative, so you don't have a grounding to be able to say what is a dollar worth, mm-hmm. and then you don't realize that they've got the hands in the back of your pocket.
Right.
Any thought on that?
Well,
or do you want me to read some Gold Telegraph headlines?
We can get into that, but okay. We are definitely living in one of the most expensive fiscal agendas in history, driven by, you mentioned, the social equality programs. We got the green revolution happening. We're underway. Infrastructure revamp, so more spending on the back of your children's children. And then even now, defense spending. You know how much silver goes into one missile, Jeremy? A lot of silver.
A lot. Here's some Gold Telegraph headlines that we can riff off of. Swiss shipments of gold to the United States surged in March to their highest level since May of 2020. Profits at HSBC have tumbled nearly 30% in the first quarter. Profits at JP Morgan tumbled 42% in the first quarter. Last year, bankers collected their biggest bonuses since the financial crisis. That's kind of an interesting one. The World Bank is warning that the world is facing its biggest energy shock since the 70s. This comparison between now and the 70s is really starting to come into focus. Russia working on linking the ruble to gold. The Financial Stability Board is saying poorer countries should bolster their financial defenses. A Bank of England official has proposed an overhaul of global capital rules for banks to make it simpler to lend during a crisis. That's an interesting one. The financial world is changing right now. Gold will play a serious role in the future, just like throughout history. That's a good one. Let's start with that. With all of this upheaval that we're seeing in the world, this race to a great reset, will it be the World Economic Great Reset? Will it be a different Great Reset? What could that reset look like? Will it be organic? Will it be planned? Who will the winners be? Does he who have the gold make the rules?
Well, definitely we're seeing a massive change, a massive shift, and even a checkmate of some sort with the silver and gold market, especially because when you have the pegging of a currency with gold, and the ambition to acquire, as Russia is doing, to acquire as much gold and as possible from now until June, this is putting the crosshairs on the futures market. And this week we had an interview that was conducted by Bloomberg Asia. And speaking on Bloomberg Asia was the founding partner at Swiss Asia Capital Singapore, Jörg Kiener, who has got about 40 years in banking. He's a vet, and he dropped a number of bombshells in this live interview. It was a live one at that. So, and his focus was on the futures market. So we're talking about the future agenda, which is going to be a gold agenda, a gold currency. Well, his focus was on the futures market because, as he mentioned on the show, live on the show, the outside silver futures and options leverage number is outnumbering the physical metal more than 100 to 1. What many listeners need to understand is the futures market was initially conceived as a way for users of the physical to hedge risk on a constant cost basis. And what he did, he pointed out that the price of the actual physical is defined by movements in the derivatives market as opposed to the actual physical trade on the ground. But his analysis of the supply and demand fundamentals now on the ground, the supply levels haven't been this low in over 20 years. This is leading to major industrials, potentially Tesla, to seek out direct agreements with the miners and the refiners to guarantee their own supply. So the Silver Institute came out with a report we talked about last week, the supply and demand report. There were just over 1 billion troy ounces of silver that was mined in 2021. In contrast, in 2021, this last year, there were more than 325 billion ounces of derivatives traded on these futures exchanges, Jeremy. COMEX, LME, 325 to 1.
And they only mined 1 billion.
And they only mine it. And talking about miners, base metal inventories are quickly running out despite increasing global demand. Zinc, smelters are shutting down, Jeremy. We've got to get into that some more.
Let's keep going with this article and see where it leads in terms of what it means for the price of gold and silver, or the value of gold and silver moving forward. The number 18778 silver, the website guildhallwealth.com. If you want to acquire some physical precious metals, maybe for the first time, go to guildhallpreciousmetals.com. It's our e-store, great way to pick up some physical metal for the first time and just kind of see a sense of the prices and what products are available. Or you can hold it in an RSP, physical, allocated, stored outside the banking system in an armed vault. The number 18778 silver, the website guildhallwealth.com. We'll be right back. And we're back. It's The Real Money Show. The number 18778 silver, the website guildhallwealth.com. Remember, if you can't hold it, you don't own it. At Guildhall, it's all about physical precious metals. Jerry, we were just talking about an article put out, a live interview with, I can't remember the names, gentlemen. Jörg Keener out of Switzerland, and he was being interviewed on Bloomberg, I believe, right?
Bloomberg Asia Live, yes.
And so just before we went to break, he was talking about the fact that they mined 1 billion ounces of silver, but the COMEX traded over 325 billion ounces of silver traded. Now, was that over the course of the year or through 2021? Okay, yeah. So that's a massive amount of paper against the physical silver, because even if 1 billion ounces are mined, most of that at this point is going into industry and investors. Mm-hmm. It's not like there's any left over. There's always a deficit in terms of every year there's more demand outstripping the supply.
Yeah, growing deficits year over year in silver. So Jörg Keener, he had a live interview just to continue this. He calls gold the bargain of a century at these prices. And he, in the live interview, says clearly the price discovery is happening on the paper markets. The exchanges are going to have to reveal that they don't have the physical, and they're going to have to correct their prices. Why? Well, the base metal inventories he was talking about are quickly running out despite increasing global demand. Zinc, in particular, Jeremy, is seeing smelters shut down around South America, Central America, at a time when inventories are already low. And the biggest byproduct of zinc is?
Zinc mining is silver.
None other than silver. Pure play silver mines outside Latin America have already been shuttered. And now the byproduct supply is also being constrained, as silver is essential to strategic applications such as the energy grid, military hardware, green tech. People are focusing increasingly on physical silver as opposed to the paper metal. Finally, basically, he says, out of all of the metals markets, gold right now presents, at these levels, the bargain of the century. A 5-figure gold will be needed to stabilize global markets. Rates charged for taking delivery from ETFs are rising. And when delivery does take place, the wait time for large quantities, as we know, is ramping up. So that rollover is becoming a big price discovery mechanism. And as he argues, there's very little gold coming into the market right now in physical, as it goes straight, where? Into the treasuries of the BRIC countries. They're swallowing it up. Russia is swallowing it up. He mentions 5-figure gold, Jeremy.
Yeah, that means north of 10,000. And at the same time, remember, it's not necessarily what the price is, but what it buys you.
That's right.
Right? Because, I like what Bill Holter has said in the past. If the dollar is worthless, then gold becomes priceless. So you have to understand that at some point here, if inflation gets out of control and the dollar's sinking rapidly, it doesn't necessarily matter where the price goes. It matters, do you own it, A, and what does it buy you now?
Yeah.
Because it will buy you more and more. In Turkey, for instance, they're experiencing 70% inflation. That's a G20 country. 70% inflation. And the government is asking its citizens to sell the gold.
Oh,
right? Nothing makes you want to buy it more than the government telling you to sell it. And obviously it's because they need liquidity, right? You need cash, currency in the bank, greasing the wheels of the financial system. Well, if the financial system is broken and it's dependent on this dollar currency, what doesn't matter what currency we're talking about here, US dollars, Canadian dollars, whatever it is, if you reach that moment where you can no longer keep the 3-card Monte game going, you can no longer keep the plates spinning, the emperor has no clothes, do you want to keep your wealth in a currency that's rapidly devaluing? I think you want to seek a different place to put it. Now, the problem here, the only challenge is that there's a cost to buy physical gold and silver. You can't just convert your paper into a physical commodity at the snap of a finger, no cost to you, and just keep on going.
Paper for paper, maybe. But
if it were that simple.
Not for physical.
But it's not. You actually have to, just like any exchange, number one, there's a difference to do an exchange and there's a cost to do an exchange. but we're actually acquiring a physical asset. It's in the real world. It's a physical asset. Now the question becomes, am I getting it at a deal? You know, in 2000, I think it was 2000 or 99 when Brown's bought him. I think it was 2000.
Yeah, Gordon Brown.
Gordon Brown. He was the finance minister of England, the exchequer, and he sold off all of England's gold, or half of it.
He announced it prior to.
And he announced it. And he was a former Goldman Sachs guy. And they called it Brown's bottom. And of course, that meant $250 gold. Now, I think the debt in the U.S. must have been something like 5-6 trillion, right? Nowhere near what it is today. Now, if you were to take the amount of debts that are around today and look at the price of gold at near $2,000 an ounce, it's actually cheaper comparative to the paper. That's the key, right?
That is the key.
Again, this is all coming back to understanding the value of the money versus the paper. You're talking about it right here, Jerry. You're saying there's 300 billion ounces of paper. Well, it's meaningless in the world we're heading into. It's all about the physical.
That's right.
What else does this guy say in the interview at Bloomberg?
Well, in closing, he calls it the bargain of the century, because where the figures are going to be going in gold, when you have nations tying their currency to gold prices, Russia's slated to revalue. That's their goal. Their ambition is to acquire and then survey the supply and demand fundamentals on gold, and then they can decide on revaluing the gold price. And the reason for this, as Kiner points out, and he's very clear, is that they're doing this to stabilize global markets. It's global stability. And in a time where we have global imbalances, a lot of changes need to be made, and a lot of profound changes are happening in the global economy. And we'll get into another headline from Crescat Capital on how to profit.
Gold provides stability in an unstable world. That's what we're talking about here. The peace of mind of knowing that your wealth is protected, that you own real money, that you're not just in paper currencies that could go up in smoke. The number 18778-SILVER, the website guildhallwealth.com. Everything we do at Guildhall is physical. If you want to acquire physical gold and silver in a registered account, it gets stored on an allocated, segregated basis, held outside the banking system in an armed vault. This is the best way to have the physical metal in as part of your retirement versus maybe perhaps a pension plan, or at least diversify. If you don't have any physical gold and silver yet, start small. Crawl, walk, run. Get your feet wet, start to understand how the market works, get a sense of pricing, and go through the process, and you'll find, comfort breeds confidence. So that's the best way to do it. Start small. Don't try to go big all at once. Just ease into the market and start to understand this market. The number 18778-SILVER, the website guildhallwealth.com. This is The Real Money Show on AM 640. We'll be right back. We're going to try to sum all of this up about what's happening with the currency, what's happening with the financial system. It's definitely in trouble. I mean, we're watching the inflation occur. We're watching stagflation occur, where we're seeing negative growth and high inflation. And, who knows what's going to occur once these supply chain disruptions continue to occur. I mean, I don't know if you've seen it. I saw the picture. Do you remember when they showed pictures of all of the container ships off the coast of California waiting to unload?
Remember that?
We never really heard much else on that story after a while. But I saw the one of the shipping containers off the coast of Shanghai. I don't know if you saw that. It was like 10 times what we saw in California because of their zero COVID policy there. I mean, it's crazy what's going on. They're like, who's believing the science? What's the science? I mean, they've shown that these things don't work versus all of the countries where they didn't lock down. It was the same number.
Right.
So pretty ridiculous. And the world is sitting there waiting while all of these container ships are off the coast of Shanghai. So we'll see how that plays out. But definitely The supply chain issue is going to be an issue, which means things are going to cost even more
Yeah.
if you can get it.
Yeah.
And that's kind of what we're seeing as a microcosm in the physical gold and silver market.
Yeah.
Before we get into the bigger picture and where the prices of metals can go within the bigger picture of the changing financial system, let's look at some of, maybe we won't get through the whole list, but some of the reasons for buying silver. This comes from Gold Broker out of Switzerland. Number one, silver is an extremely undervalued asset. Historically, one could buy 15 ounces of silver with 1 ounce of gold. Today, 1 ounce of gold buys 71 ounces of gold. So obviously we've spoken a little bit about this in the past, the idea that the historic norm is 16-1, and if you believe in things reverting to the norm, then you would say, okay, silver's got a long, long way to go here. It's definitely undervalued. And part of that is it is a small market. Mm-hmm. And if you're trading 320 billion ounces, maybe the price is going to come out of whack with the physical market. You've got to look at that as an opportunity, not look at it as, oh wow, this whole thing's rigged. No, it's an opportunity because we're quickly moving into a world of real things. Mm-hmm. Number two, if we consider the historical trend over a millennia, the price of silver should be $86 today, which is the gold price divided by 15. That's based on the 72-1. Silver is one of the rare commodities trading for less than it did in 1980. I think that's kind of an interesting one, right? In 1980, it hit $52 an ounce. Gold hit 850. The debt in the U.S. was $1 trillion. Mm-hmm. And you could buy a house for, I don't know, less than 100,000, 150,000.
Yep.
So that kind of puts things into perspective on what this commodity is versus the other commodities. And again, that is incredible opportunity. Mm-hmm. And we'll talk about where the prices could go. The enormous industrial demand, partly responsible for pushing prices, but it will not diminish as the price rises. Why? Because the metal is used in very small quantities in each product. So even a strong increase in price would not bring a lessened industrial demand. That basically is saying that the price is inelastic. If you're putting a 1/4 ounce into a computer, if the price quadruples on you, you still put the 1/4 ounce in the computer, mm-hmm. right? And it's not going to really change the outcome of the price of the computer anyway. So they're using such small amounts in, contact points in anything electronic and digital. It's such a small, minute amount that it won't change even if the price goes sky high. But the demand on it remains the same or continues to grow.
Interesting.
And what's interesting on that side of things with the industrial side, of course, is that we haven't seen the end of inventions. Great iPads and iPhones.
What's next?
But what's next?
Right.
How are things going to continue to progress? What new technologies are they going to bring forth? And silver is in anything digital and anything electronic. Mm-hmm. So the sky's the limit in terms of the continuing demand on the product. And you could look at other industries like the medical industry. Silver naturally absorbs bacteria. That's why they came up with that's why you have the adage of a silver spoon. Born with a silver spoon in your mouth, it would absorb the bacteria. The kid's healthy. Mm-hmm. Right? Not the tin spoons or the, whatever we're using today.
Pure physical silver.
Exactly. So let's look at the bigger picture. We'll stop there. Let's look at some of the bigger picture points mm-hmm. that we want to get to before we conclude the show.
Yeah, regarding a lot of changes that is happening, Crescat Capital released their now Crescat Capital asset manager in the States. They released their latest monthly research letter late last week. And as usual, it provided a clear and really concise insight into the macro markets at present, backed up with some runs on the board through the outperformance of their funds. And the summary intro to their letter summed up the current situation. They were cited as saying, "We are currently experiencing profound changes in the global economy that are likely to unleash a plethora of early-stage secular trends in a new inflationary regime. These are long overdue structural shifts powered by decades of easy money policies," we've seen that, "and record levels of debt to GDP among the developed economy." And here are some of the changes. Governments and central banks to seek high-quality international reserves, like gold, In an attempt to restore the credibility of fiat currencies, gold will play a major role as a monetary asset. Another change, central banks ultimately forced to cap long-term yields, creating a major tailwind for inflationary assets. Further, deglobalization trends, which I love, prompts a long overdue manufacturing rebuild in developed economies, including a boost to non-residential construction and overall corporate margins to be squeezed by the rise in the cost of capital, commodity prices, and labor costs as the Fed tightens monetary conditions. So we're seeing ultimately now a resurgence of fundamental analysis and value investing principles as profitability becomes a priority. Reminds me of OMERS. They're going to have to research and redo their fundamental analysis to bring back some profitability, maybe revisit the gold idea pensions. Well, they kind of concluded as saying the scenario is setting the stage for significant changes and how to profit towards overvalued assets to unloved, historically cheap alternatives. And for macro investors, we think this is one of the most opportunistic times ever. And they bring up Mr. Silver. Silver remains one of the most mispriced opportunities in the financial markets today. While the overall commodities market has already drastically risen, the canary in the coal mine, the high beta version of gold remains at historically cheap levels. If silver were to just catch up to the move in other tangible asset, it will imply multiple from its current levels, multiple times higher from its current levels.
Profound changes indeed, Jerry. If you're looking at 5-figure gold, that means gold into the 10,000 plus. That means at 16 to 1, silver could be trading in the 900 plus range. This is the market. Protect yourself. Gold, silver, the number 18778 silver, the website guildhallwealth.com. That does it for another edition of The Real Money Show. Thank you so much for listening. We look forward to speaking with you again next week here on The Real Money Show on AM 640.